Fears are flying about a potential market correction, especially in the AI and tech sector. While that might happen, long-term bulls know how to profit from any short-term pullbacks. Joining us today is Chris Rowe with True Market Insiders. He's going to share 3 reasons why he's expecting some kind of correction yet this year, but how he suggests investors can really profit from any kind of pullback we see in the next 6 months. Chris, so glad to have you back on the show. I know you are in the markets every day, and you are always looking for those high growth opportunities for investors. So we're going to get into your 3 ways to profit from any kind of correction we have coming. But first, I want you to talk about where you think the market is heading in the second half of this year.
In a midterm election year, you expect the market to basically tank from the summer down to the October to November range. There's several forces that you could see are already positioning and prepping for that. It's already in play. It's not something that I'm speculating that I think is going to happen. You can see it unfolding right in front of us right now.
Would you call yourself an actual bear who's bearish on where the market is heading over the next year or two? Or what would you call yourself as far as where you think the market is going to go overall? We've been in such a bull run for a very long time. Do you think that can continue, or are you a full-on bear?
Well, I definitely wouldn't call myself a full-on bear. I'm a long-term bull for sure. It's a very strong market. We're seeing a lot of signs of strength in this market, but markets pull back, they correct. And then when that happens, the question is it a disaster? Are you running around with your hair on fire, wondering what you should do next? Or do you know that it's a long-term bull market and you're looking at it as a huge opportunity? So I see a correction coming. I'm super excited about it. In this case, I can't wait for it to happen because I can buy some oversold quality names.
I think there's a lot of investors in your same boat who are actually hoping for some kind of pullback to really have some opportunity for bigger gains in their own portfolios. So there's plenty of people in your same boat. I want to hear from them in the comments. If that's you, if you're waiting on a pullback and hoping it happens, let me know in the comments. Chris, let's talk about, you gave one indicator already that you're watching, and that's midterm election year, for why you think that there could be a pullback coming for the second half of 2026. Are there any other market indicators you're watching that are showing you that we may be in for some kind of correction this year?
Well, the 2 other things that I'm looking at, very basic, is price volume activity. If you look at the chart of the S&P 500 and look at the volume over the last 3 years, what you're showing on your screen now is a 3-year weekly chart of the S&P 500. You can very easily see that the recent rally has happened on historically low volume, and a rally without strong volume confirming it is basically a rally that's going to eventually fail and pull back. And if the market rallied that high without volume, when the pullback happens, it's probably going to be swift. It's probably going to be very painful for a lot of people who don't expect it. It'll be sharp. I would expect a pretty big correction. Not an all-out bear market, I want to be clear, but since the market rallied without real legs behind it this whole time, what's going to happen when the sellers finally come in? We already caught a glimpse of that. If you look at the price volume activity, after the market rallied for a long time on very light volume, all of a sudden, volume came into the market, but that's when the market started selling off. If you look prior to when the market had rallied on light volume, you can see a lot of big red volume bars at the bottom of the screen. That means that the market was down that week, and you can see the big red volume bars means that there's been big volume when the market's down. That means there was selling leading up to February, and then in March, you had a big sell-off. The market rallied from March on light volume, and now that selling volume is starting to come in again. So the market's vulnerable, and we're prepared for it.
Okay, so midterm election year, volume in the S&P 500, those are 2 of the indicators that you're watching. What's that 3rd indicator you're watching that shows you that there's a correction potential yet this year?
So this is an indicator it's on our website, truemarketinsiders.com/BPI. And it looks like a bunch of confusing X's and O's. If you look at the far right column, it's in a column of O's. And all that means is that this reading most recently went down by a lot. If you look at the top, it says 51.31%. It means that 51% of stocks listed on the New York Stock Exchange are on buy signals. The remaining 49% are on sell signals. And that reading has been going down pretty quickly. Basically, what that means is more and more stocks on sell signals. That means more and more stocks are more likely to go down than up. They have an easier time declining than they do advancing. A typical breadth indicator, but it's actually the granddaddy of all breadth indicators. So when you see less participation on the upside, more participation on the downside. You have a larger number of stocks participating in bearish moves and fewer stocks participating in bullish moves. And this is something classic that you see right before a market corrects.
All right, so three super interesting indicators. Again, it looks so technical, but you explained it so well in very layman's terms about what is happening in the market and why you are watching these. Chris, you are very good at making complex information seem very easy to understand. If you like learning from Chris, he's going to dive into 3 ways to profit from this potential correction coming this year in just a minute. But if you want to hear more from Chris, make sure to sign up for his newsletter. We have a very special offer just for our viewers today who want to continue learning from Chris and how he watches the market and the recommendations he has too. You can scan the QR code or click the link in the description again to take advantage of this special offer to sign up for a full year of access to his sector-focused newsletter and learn more from him and the team at True Market Insiders. All right, Chris, let's dive into the recommendations on how to profit. And that is one thing that most investors want to hear about. So if this correction is coming, what should they be doing in the meantime? Should they just be holding cash, waiting for that, market bottom before they buy in for that increase coming next year, according to historical data there that you explained earlier? Or is there something they can be doing to profit in that in-between phase?
First, I'll say that the most important thing for investors is that they do what they're comfortable with doing. You don't want to get aggressive in a market and then the market gets crazy and choppy and then you cancel everything. You just run away and you abandon what your strategy was. So you have to do something that's comfortable for you. That might mean adding some cash to your portfolio, reducing your exposure to the stock market for a while. That might mean taking a bearish position to hedge your portfolio. The 3 things that I'm bringing to the table today are 2 ETFs and a stock. The first ETF are the junior gold miners, GDXJ. And the reason I say GDXJ, which is basically the precious metals sector of the stock market, is precious metals have gotten clobbered in recent months. Over the last few years, they've maintained probably the number 1 position in terms of the strongest sectors, the strongest price performance, and it's a very volatile sector, but that means huge gains when it swings back to the upside. Right now, it's beaten down really badly. So if the stock market reverses its uptrend and then investors move to the flight to quality sector being precious metals, it's already overdone, it's already oversold. I think both of those trends reverse. Stock market declines, precious metals resume their long-term bull rally. I mean, that's a mega trend that you want to be a part of. We are blessed right now to see precious metal stocks already oversold.
Yeah, oversold is right for these names. I can see this ETF is down a little over 16% in the last 3 months. So it's definitely on the downtrend right now. I think what you're saying makes sense, Chris. Just knowing that anytime we see a correction or any kind of market fears about the stock market pulling back, some kind of economic crash, people often turn to gold and silver and precious metals. We've seen that time and time again in the few major corrections that we've seen in the market before. So it does make sense that this would be an area that people would be moving to. I'm wondering about timeline when it comes to this correction that could be coming. Are we talking about this ETF could continue to go down all the way until October, or is now a time to be interested in entering into something like this? Does it have a chance to turn around sooner than that October, November bottom that we could be looking at?
I think when it comes to precious metals, now is the time to get in. What you're doing here, this is called a counter trend trade. You're buying something that's already beaten down. It's been in a downtrend for quite a long time. Almost all of the selling that's going to happen in this sector has already happened. Now, there might be a little bit more selling, but that's okay. Precious metals is right now a screaming buy, especially for those that are willing to hold on to it for the next several years. If you're going to hold on to it just for the next several months until the stock market correction is over, I think it's still a great time to buy it.
Okay, that timeline is really helpful, Chris, of knowing how long investors should be holding a stock like this. I want to look back historically a little bit. Right now, it seems like gold and silver is on a pullback, although we did see the price of gold kind of getting a little bit of a recovery in the last few weeks or so. But let's talk about historically, how have these stocks performed, especially during these times of correction that we're predicting?
We track 45 sectors. So we break the stock market into 45 groups. The precious metals sector, about a third of the time since the April crash last year in 2025, about a third of the time, the precious metal sector was the number 1 sector out of 45 sectors in terms of price performance. So you would have rather have been in that sector than any other 44 sectors. And that was for a third of the time. So it's been a mega trend that I think is not only good for investors that are looking to protect their profits and find a flight to quality, I think it's also a very fun sector for speculative investors to play. The stocks in those sectors double, triple, and quadruple very easily. And really the reason that it's pulled back so much is just because it had such enormous gains in such a short period of time.
I think another thing to talk about is you suggesting an ETF rather than individual mining stocks. I know we've had some people on the channel just in the last week talking about investing in gold and where you can find really outsized returns with some of these junior miners and these smaller companies, but to expect lots of volatility. Does the ETF way of looking at this help protect from some of the volatility you can get from picking individual miners?
Absolutely. Diversification is always going to hedge off a volatility risk. So you do have the upside of an individual stock, and at the same time, it does hedge off that volatility risk by being diversified.
All right, Chris, let's move on to that second area. You are looking to find some profits even during any kind of correction we might see in the next second half of 2026.
It's related. It's the metals and mining sector. So as opposed to precious metals sector, it's the metals and mining sector. You can break commodities as a whole into four major groups: energy, agriculture, precious metals, and industrial metals. And today we're focusing on the second two, precious metals and industrial metals. So XME is an exchange traded fund that investors can invest in for industrial metals, metals and mining stocks. You have to remember, metals and mining is actually sort of becoming part of the tech sector because metals and mining is where they find the components that they need for batteries, for semiconductors, for a lot of the technology that makes the world go round. The government is investing in mines in Canada. The biggest spending comes from governments and superpowers. If you look at how much of the budget is spent on defense, how much of that money flows into defense stocks, and some of these defense stocks trade up 5 or 6 or 7 times when they're small speculative companies. Just apply that same logic to metals and mining companies. And these metals and mining companies are getting big investments from governments around the world as they race to become the dominant player in technology overall.
Yeah, we've talked about several of those individual mining companies, several of the ones that have seen that government investment, especially from the US. But like you said, there's governments all over the world that are making similar investments in some of these companies. But again, I think this ETF approach is interesting for investors and perhaps a safer way to look at it. I think sometimes when we talk about so many stocks on this channel, we have someone on every day offering different ideas of which stocks to invest in. It can be hard to pick which ones you think will be the winner in different industries. And so this ETF approach is very interesting. This particular ETF, do you know, does it include mostly those US mining stocks, or is it a little diversified with some of those more global ones as well?
U.S. mining stocks. These are the mining companies that are in the S&P. So these are U.S. stocks.
Okay, that's an important note for some people who are specifically looking at the companies that the U.S. government is also investing in. And let's talk about the pullback a little bit on this one too. Down over 21% in just 1 month. That's a pretty big pullback, especially for an ETF that has multiple stocks. Why are we seeing such a drastic pullback in the last month on some of these names?
Same as before. I mean, this is the sector that's absolutely crushing. If precious metals is ranked number 1, this sector is around 2 or 3 most of the time. In general, the big boom, the mega trend that you want to be invested in, all ties back to technology, and it kind of ties back to commodities as technology and commodities kind of merge together. So these are the sectors that have been the best performers, and they're the sectors that are therefore going to have the biggest pullbacks.
Yeah, and again, these stocks have pulled back as big tech stocks have had a really great last few months. And so I think that's an interesting point of if we see that rotation with some kind of overall wider market correction, tech is usually what's hit first, and perhaps we'll see more rotation into some of these more commodity type stocks and investments. We just had another new guest on the channel this week who had a very similar recommendation of investors looking at commodities during a time of a potential AI bubble, and if we see some kind of market correction. Now, you are more of a long-term bull. That other guest we had on was more of a long-term bear for sure. But it's interesting to hear two different people saying very similar things in the same week on this channel. For those of you who watch all of our videos, I want to hear from you what you think about hearing a similar move to commodities during this summer season ahead of moving into the fall and the midterm election cycle. I want to hear your thoughts about hearing this more than one time on this channel. But Chris, I know you have one more name for us, and the first two have been ETFs, but another thing, we've had you on the show before. You're really great at finding these really small speculative investments, trying to get short-term gains. So we're going to get into that name in a minute. But if that's the kind of thing that you're looking for as an investor, it's alerts to these small random companies before they see a big takeoff. That is what Chris specializes in. And you can subscribe to his newsletter today for a full year access, a very special offer just for our MarketBeat listeners today. So if you want to take advantage of that offer and learn more from Chris in the future, scan the QR code or click the link in the description to get access to his system today, and also some special reports that give away some other stock tickers. He has a report with 3 names that are right along the lines of what we are talking about in this video today, so you can find some more stock suggestions there too. All right, Chris, let's get to this last name, and a warning for investors. This one is the most speculative option on your list of ways to profit today.
Yeah, this is what we call no tears investment. There's a stock that's actually, it's a real company. It's a company that's doing well. It's a big turnaround play, but try to forget about the story for a second. You've got a stock that's been trading between $1 and $2 a share. Right now it's at $1.32. This is a stock that recently traded to $30. So you're investing $1 or $2 to potentially make $20 or $30 on the upside. Now, the stock had that big swing when we had what I'm calling the Iran situation. They don't refer to it as a war, so we'll just call it the Iran situation. But when there's trouble in Iran, there's potentially trouble disrupting the oil markets. Oil prices spike, it really leans on the economy. And the last time that the stock market had a significant pullback, it was because of fears of a weakening economy, because potentially we would have higher oil prices, among other things. Well, if you have a portfolio that gets beaten down because of something that's going on in Iran, because of high energy prices, if you own BATL in your portfolio, which is Battalion Oil Corporation, again, that's BATL, that's a stock that could potentially double, triple, maybe even 20x. It's a real company and a high quality company, and I'll get into that in a second. But just think of it primarily as a hedge against a market that's declining because of high oil prices. If you have 5% of your portfolio in this company and the stock 10x's, then that's going to take a $5,000 investment, turn it into a $50,000 investment. And if you had an overall $100,000 account that also pulled back, you're going to have a wild profit when the market pulls back. Then you're going to be able to get out of this. Remember, you want to get out of this quick. You want to be quick to sell. So you want to take your profits very quickly. Just a couple of weeks ago, I took 110% profit in a day on this stock. But if the stock market's getting beaten down because of higher oil prices, BATL trades up 1, 2, 3, 10 times, you're going to have a lot of cash to play with when the market's oversold from a correction, and you'll be able to buy some of those stocks that you've been watching trade higher, wishing that you had gotten your hands on them.
I think for some viewers listening to this, they're like, that's gambling. This is not the kind of stock that I look for. But I also think the way that you described that is interesting. This is the kind of name that moves a lot on any headlines that involved with the Iran conflict and Iran situation. And we know those come all the time. There's a peace agreement, then there's not a peace agreement. There's an agreement to let people go through the Strait of Hormuz, and then there's not. And so I think that this is an interesting way to play those headlines. And like you said, potentially take some short-term profits. You definitely have to be paying attention to what's happening with this stock and be prepared to be very nimble with it. So if that's a kind of investor you are, this is an interesting story. We're going to dive into that a little bit more. If that sounds too risky and like too much work for you, I don't think this is the right investment for you. It just depends on the kinds of opportunities that you're looking for and knowing the kind of risk that you're comfortable with. Let's talk about this company too, Chris. Why do you've said a few times that it's still a solid company, even though you're looking to play it more on the headlines.
Yeah.
Let's talk about the company itself.
First of all, just to add to what you just said, Trump put out a tweet saying that Iran better get their act together, or just an aggressive tweet on Iran, and the stock doubled just from that aggressive tweet. The next day, it was right back down to where it started from. So if you bought at the high, your investment got cut in half. But if you bought right when I told everybody to buy it, the investment doubled. Now, the company itself is a good company. They're an operational turnaround play. So the company successfully resolved some major gas processing issues that it had, some constraints that basically were limiting production, long story short. So this allowed oil output to increase meaningfully just recently. They also are very highly leveraged to oil prices in general. It's a pure play Permian producer, low break-even costs, and the quality, basically the acreage that they own, is in some of the best parts of the Delaware Basin, supporting strong well productivity and future drilling inventory. There's a lot of momentum that's happening with this company, a lot of positive momentum. And you can look at it like a piece of paper that's at $1.30, and you're risking $1.30 perhaps to make 10 or 20 bucks if there's some sort of an oil crisis. Look at it that way. But in the meantime, I don't think you're risking seeing this thing trade to zero or into the pennies. I really don't. I think maybe your downside is you deal with a lot of volatility, maybe a 30% decline to the downside. But again, that's for a potential 10x, 20x in stock.
I also want to talk about this is an idea that you have for investors who are looking to get some profits so that you have some cash ready for that potential pullback that might be coming later on this year. So let's talk about that a little bit too, about being ready to take advantage of any kind of correction we see in the market. Is October really your timeline for thinking ahead to buy the bottom, so to say, of what many investors are looking to do and take advantage of that any kind of correction we might see?
I don't predict or forecast. I don't predict or forecast. I could just very clearly see what's happening to the market right now, and I adjust my portfolio accordingly. So right now, what we're seeing in the market is supply has taken control of the supply-demand relationship. Large fund managers are putting what's called sell programs. It takes these fund managers a long time to exit positions or to raise cash by selling stock. They don't just do it in a day like you might do at home trading on E-Trade. Sell programs are already in play. I can see it happening. So we're adjusting ourselves according to that. So I don't want to say that in October, that's when the bottom happens. I can't predict that. I don't have a crystal ball. But generally, in a midterm election year, markets sell off. And when markets sell off in any given year, October, November is generally a place where you can almost expect the sell-off to end and for the rebound to begin. Now, from the midterm election year low, on average, to the following year's high, on average, the NASDAQ gains about 70%. The S&P 500 gains about 47%. Again, we're talking about stock market averages. The S&P 500 over any multi-decade period returns about 7 or 8%, 9% if you get a good decade. We're talking about a 47% gain from the midterm low to the following year high. And for the NASDAQ, that's a 70% gain. The following year, the pre-election year, next year, is the strongest year out of the 4-year presidential election cycle. And the midterm year, the one we're in right now, is the weakest year of the 4-year presidential election cycle. So thinking about those broad strokes, I think is what's going to be best for people. And usually towards the end of the year, when the midterm election actually happens, that's usually when you see the low. And after that midterm election happens, immediately after, I mean days after, pay very close attention to which groups of stocks perform the best, because based on who gets elected, who takes power, that's when the market reshuffles suddenly. And whatever sector is the best performing sector immediately after the midterm elections, you can almost count on that being the best performing sector, maybe the second best performing sector for the next couple of years.
Such a good lesson for new investors to keep in mind is that cyclical cycle, what we've seen historically. Past performance does not mean that we're going to see that same thing happen again, but it's always important to pay attention to what the market has done before, especially when we're heading into a midterm election cycle like we are this year. Chris, a lot of great information for viewers. Thank you for that. If you want to hear more of this perspective on heading into commodities during a time when many analysts are expecting a little bit of correction in the market, make sure to watch this video. It's perhaps the most contrarian approach to the market that we have ever seen on our MarketBeat channel. So if you want to watch that full interview, make sure to check out that perspective here.